Welcome to vTalkInsight, Allocator's Lens Daily from March 27th, 2026. Cross-asset today is all about the energy shock from the Middle East colliding with higher real yields and fading safe havens. Oil, bonds, and the dollar are pulling portfolios in different directions, while equities sit between resilient fundamentals and rising tail risks. Let's start with how that tension is showing up in global equities. In equities, the story is a tug of war between still solid fundamentals and an increasingly hostile macro backdrop. U.S. stocks are being treated as a relative safe haven compared with more energy-dependent regions. Yet the threshold for genuinely negative news is now very high, which suggests geopolitical tail risks may be underappreciated. Headline indices are down only around the mid-single digits from their peaks, but recent sessions saw the S&P 500 fall almost 2% with the Nasdaq underperforming and volatility gauges holding in the mid-20s. Beneath the index level, the damage is more severe and more uneven. Energy stocks have outperformed sharply as crude spikes, while tech, industrials, and consumer discretionary names have led the declines, with utilities one of the few sectors avoiding big drawdowns. There is also a stark concentration story. Recent U.S. equity gains have been powered by a narrow group of large tech and semiconductor names, especially those tied to artificial intelligence infrastructure. At the same time, retail investors have started trimming exposure to high-growth leaders like NVIDIA, which hints that the enthusiasm around AI may be cooling at the margin. Fundamentals still look respectable on paper. Earnings forecasts for the S&P 500 have been revised up, with some expecting mid-teens growth this year and projecting index levels well above today in benign scenarios. On a price-to-earnings growth basis, valuations have slipped below their 10-year average, suggesting some repair after the recent sell-off. Small caps in particular are seen as offering better medium-term value, with improving earnings expectations, provided commodity markets eventually stabilize. The problem is that the macro shock keeps getting bigger and harder to model. Oil has surged on fears around the Strait of Hormuz, feeding a stagflationary impulse where inflation expectations drift higher while growth expectations soften. Scenario work now maps out a very wide range for the S&P 500, from recovery paths back toward prior highs if disruptions fade, to downside cases where earnings and multiples compress enough to push the index meaningfully lower from here. So far, we have not seen the classic signs of capitulation in volumes or correlations, and cash balances are at multi-year highs, which means there is dry powder, but also room for further de-risking if headlines deteriorate. For an allocator, the key is how equities interact with oil and rates from here. The correlation between crude prices and stocks is highly negative at the moment, and a break higher in 10-year Treasury yields toward the mid-4% range would historically be a headwind for valuations. Watch for how upcoming earnings guidance absorbs higher transport and energy costs in sectors like airlines, manufacturing, and fertilizer, and whether ETF flows into broad equity indices remain resilient or start to reverse. Those signals will help clarify whether equities are simply consolidating after a strong run or repricing into a more durable stagflation regime. That takes us naturally to the rates market, where much of this repricing is already visible. Rates are now at the center of the adjustment, with yields moving higher across the Treasury curve. Recent auctions in 2- and 5-year maturities have been notably weak, with low bid-to-cover ratios and dealers taking down their largest share since early in the tightening cycle. Current Treasury yields in the low to mid-4% range are seen by some as fair compensation for large deficits and rising debt, yet the balance of risk still points to additional long and selling if fiscal concerns intensify or foreign demand continues to wane. Importantly, the latest move higher in yields has been driven more by rising real rates than by inflation expectations. Longer-term break-even measures remain relatively contained, while markets now price out Federal Reserve rate cuts for the rest of the year and assign a meaningful probability to an additional hike into the autumn. Hawkish commentary, including a higher year-end policy projection, reinforces this higher for longer narrative and supports the idea that the neutral rate may be above earlier estimates, given how resilient the U.S. economy has been. This rate backdrop has eroded the classic role of government bonds as a clean hedge for equity risk. Higher real yields have weighed on both risk assets and on traditional safe havens like gold, while a structurally higher term premium reflect persistent geopolitical and supply shocks. For portfolios, That means the mix of duration and cash becomes more nuanced, with short and medium-dated sovereigns offering improved defensive potential, but longer duration exposure carrying more sensitivity to both fiscal and inflation surprises. The next pressure point to watch is the 10-year yield zone around the mid-4%, where past episodes have coincided with greater equity volatility. Credit markets are already signaling strain in that environment. Credit is where the cumulative impact of higher rates, energy shocks, and sector-specific issues is becoming most visible. Spreads have widened from tight levels as defaults creep higher and software and other leverage segments face more scrutiny. Even without a base case of outright recession, the prevailing view is that spreads are likely to widen further, reflecting a recognition that the last leg of the tightening cycle tends to be roughest for weaker balance sheets. In private credit, the story is more complicated. The asset class has grown from a niche to a central funding channel, helped by the secular retreat of bank lending, and demand for core middle market lending remains strong, with low reported defaults and decent covenant protection. At the same time, some of the largest funds have just posted their worst monthly losses in years, imposed or maintained withdrawal limits, and face rising questions around liquidity, valuation marks, and the true size of any illiquidity premium. Concentration risk has built up in big club deals, and correlations with leveraged loans are increasing, which challenges the idea that private credit behaves as a distinct diversifier. There are clear signs of stress, but the consensus view is that systemic risk from private credit remains contained for now. U.S. banks are in healthier shape than before the global financial crisis, and policymakers still have meaningful tools should a downturn emerge. The more immediate concern is what one industry veteran called the fire risk in private assets, a buildup of unsold inventory and potentially overvalued holdings that could see abrupt markdowns if a macro or idiosyncratic shock hits. For allocators, monitoring redemption trends, leveraged borrower performance, and the relative compensation of high yield versus equity risk will be key to judging how much additional spread widening may lie ahead. Those credit dynamics feed directly into currency markets, especially for more vulnerable emerging economies. Foreign exchange is reflecting both the energy shock and the shifting rate landscape. The dollar has benefited from safe haven demand, from the perception that U.S. assets are relatively insulated by domestic energy production, and from expectations that U.S. productivity gains tied to artificial intelligence could support medium-term growth. By contrast, several emerging market currencies have come under heavy pressure, hit by outflows from crowded positions and by the double squeeze of higher imported energy costs and weaker exchange rates. Energy importing economies face the risk that this combination accelerates consumer slowdowns and erodes real incomes faster than in developed markets, while some oil exporting emerging economies, such as parts of Latin America and Africa, are enjoying a temporary cushion from stronger terms of trade and more conservative monetary policy. Gold, which would typically be expected to shine in a geopolitical crisis, has not delivered its usual hedge so far. Higher real yields and a firmer dollar have capped bullion prices, and there is an additional overhang from the possibility that some central banks could tap gold reserves to help fund widening fiscal needs. That leaves the dollar as the more reliable defensive asset in the current configuration, but with the caveat that prolonged strength tightens global financial conditions and can feed back into weaker demand abroad. Those feedback loops are clearest in commodities, where oil remains the central macro variable. Commodities, and oil in particular, are the pivot around which the rest of the asset mix is turning. Disruptions around the Strait of Hormuz have dramatically reduced tanker traffic and removed a sizable share of global crude and product flows, with no easy short-term replacement. Benchmark crude prices have surged well above $90 per barrel, with Brent trading north of $100. Incredible scenarios now model temporary spikes toward $150 or beyond if conflict persists into the summer. This is feeding directly into higher prices for gasoline, diesel, and jet fuel, with U.S. pump prices in some regions already at politically sensitive levels. The result is a classic cost push shock that reinforces the stagflation narrative. International bodies have revised up their inflation forecasts, citing energy as a key driver, and elevated government debt worldwide limits the scope for fiscal offsets to shield households from higher bills. For now, U.S. consumers have largely absorbed the blow by reallocating spending, and prior momentum in demand has helped keep recession risk contained. But if oil remains elevated or moves higher, margin pressure will intensify for manufacturers, transport companies, and energy-intensive businesses, and the drag on global growth is likely to build. From a positioning perspective, there are signs of one-sided exposure. Hedge funds are reported to be extremely long crude, while physical producers are actively selling into the rally, and there is a notable disconnect between very tight physical markets in parts of Asia and more comfortable conditions in some Atlantic Basin paper markets. That raises the risk of sharp two-way moves if diplomatic headlines shift or if demand destruction becomes more visible. At the same time, because traditional hedges like long-duration bonds and gold have underperformed, commodities and related real assets have become the de facto portfolio ballast for some allocators this year. What matters next is the interaction between energy prices and policy. A prolonged period of heightened Middle East conflict, with phases of escalation followed by low-intensity warfare, would support a structurally higher oil risk premium and keep cross-asset correlations in their current stress configuration. Conversely, any durable progress in negotiations that restores confidence in Gulf shipping lanes could trigger both a pullback in crude and a rapid rotation across other asset classes. Keeping an eye on refined product spreads into the key summer travel season, and on whether consumers finally start cutting back rather than just reshuffling spending, will be critical inputs for portfolio risk management. All of these strands come together in the cross-asset picture we will wrap up with now. Across the major asset classes, the common thread is an external oil shock colliding with a higher-for-longer rates regime and less reliable hedges. Equities still enjoy upgraded earnings and some valuation repair, but sit between concentrated AI-driven leadership and rising geopolitical downside scenarios. Rates markets have repriced real yield higher as fiscal and term premium concerns build, eroding the diversification benefits of long-duration bonds. Credit is absorbing that pressure through wider public spreads and emerging stresses in parts of private credit, even as middle-market lending still looks comparatively robust. In currencies, a firm dollar and weaker emerging market FX mirror those tensions, while gold struggles to play its usual safe haven role. Commodities, especially oil, have become both the main driver of stagflation risk and, for some, the new ballast in place of bonds. For allocators, the key variables to watch are the path of the Middle East conflict, the reaction function of central banks to persistent energy-driven inflation, the breadth and quality of equity earnings, and any new signs of strain in private credit and emerging markets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.